Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So there are so many buyers and sellers making things happen here in Dallas, Texas, but we're getting a lot of comments and questions around assumable loans. People are wanting to buy houses and take over the loan that the current owner has because the interest rate is somewhere around 2, 3, or 4%. So if assumable loans is something that you're interested in, stick around. In this video, I'm going to show you all the tips and secrets on how to get them. An assumable home loan is when a buyer not only buys the house from the seller, they take over the home loan. They assume that loan versus getting a brand new one from somebody like me. Now there's a couple reasons behind this, okay? The biggest components about assumable loans and the reason that these are becoming more popular and there's a lot more talk of the town about them is a lot of these sellers that bought their houses, in the last 2 or 3 years, they've got interest rates on their loans anywhere between 3% and 4%. And so if you're a buyer wanting to buy that house, would you want an FHA loan at 3% or would you want an FHA loan at the current market of 6.5%? So the thought behind this is that if the seller has a loan on their property, can they assume it through the transaction because it will save them money? It's not that easy. So this is the fun part for me because we're gonna unpack and peel back the onion so you guys know exactly how it works, why it works, and if it's for you. So the first thing is FHA loans are assumable loans. So if you are an FHA buyer and the seller that you're buying the house from has an FHA loan, you can assume that FHA loan from the seller. Same thing pertains to VA. If you're a veteran and you want to get a VA loan, but the current seller that you're buying the house from has a VA loan, VA loans are also assumable, so in theory you could assume that loan. USDA loans are as well. Conventionals normally are not. Conventionals have what's called a due on sale clause, which means you can't basically transfer anything over. Conventional loans do allow for the loan to be assumed sometimes when you're on an adjustable rate mortgage and not on a fixed product. So majority of the time, conventionals no. FHA and VA are the most popular, and sometimes USDA. Okay, so that way you guys understand exactly what loan products allow for it and which ones don't. Now, here's where the fun part comes in for the buyer. So let's say we find a transaction where it makes sense and you want to make it happen. As the buyer, you don't just assume the loan through the seller as part of the transaction. You have to qualify with the bank that's holding the current note. Let's say 123 Mortgage currently has an FHA note on a property and you want to buy the house from that seller and you want to assume that loan. So what happens is you and the seller have to call into the servicer, the mortgage company collecting the payments, and say, hey, I would like to assume this person's loan. So number one, it has to be your primary residence, okay? If it's any other occupancy type other than a primary residence, it won't work because FHA loans are for primary, VA loans are for primary, USDA loans for primary, okay? So it has to be your primary home first and foremost. Assuming that's the case, you call into the servicer. You as the buyer to assume that loan, you still have to qualify. So you're still gonna have to provide a credit score, a credit profile, proof of income, documents, all these things. They wanna make sure that the person taking over, AKA assuming the loan, can make the payments and then they can perform because they wanna make sure that in the event that they allow you to assume the loan, that you can perform and you're qualified. So that's part one. There are still qualification components of it, okay? Part two always ends up being the hardest part for buyers that they're not aware of. Let's say all that works. You find a house, the seller agrees to sell you the house, they agree to let you assume the loan, you call in for a couple of weeks and do your pre-qualification assumable financial request through the servicer, they say you guys are approved, you can assume this loan, everything is lining up for you, so far so good. But here is the biggest thing that buyers have an issue with. The equity position that the seller has to be paid to the seller because they want their proceeds. So if you're buying a $300,000 house and the owner of that house on that assumable loan has a $250,000 loan balance, that means that owner has $50,000 of equity in that property. So if he or she were to sell that property outright, they would net $50,000 on the proceeds. So you as the buyer have to make up the difference with your own money to pay the seller. If you've got your own cash, you can pay them that way, but a lot of buyers don't have it. or a lot of buyers don't want to use it. Some people will go out and get a second loan, like a home equity line of credit, or they'll go out and get just like a personal loan through like some online bank. So the downside with that is if you have to get a second loan some way, somehow, to pay the seller that $50,000 for their proceeds, all of a sudden you've got two loans against the property, and that really defeats the purpose of doing what you wanted to do, which was assume the original notes with a really low rate and a really low payment to keep your overhead low. Now you've got a combined mortgage payment that's probably higher than if you just got a traditional mortgage through me. Plus, obviously, you don't have to come out of pocket on anything except for the minimal down when you get a traditional loan. So those are some catches on assumable loans that I want you guys to be aware of and just understand it's more of a buzzword. Now, sometimes it does work. So again, let's fast forward even one more step. Let's say somehow, some way you've got that $50,000, the transaction closes, the house is yours, the deed is yours, you assume the mortgage loan through the mortgage company. Now they're sending everything to you, you're making the payments. So here's the other thing to remember about assumable loans. A lot of them, I would say majority of them, when you assume that loan from the original seller, that mortgage still stays open and active on their credit report. Meaning you're just assuming the responsibility for the mortgage and the payment, but the creditor is still reporting it to the original person that opened it up the first time. This is something that a lot of people don't know. The seller has to understand they take a risk that if something happens, that will actually go back and hit the credit and the credit score of the previous owner that gave the assumable loan up. So how do you get out of that? How do you eliminate that risk? Well, you can go in more depth with the servicer, but it's case by case to get that actual mortgage note closed and get it opened on the new buyer. Not every servicer will do it. The only other option is to refinance the mortgage out of the seller's name into the buyer's new name. But of course, people don't want to refinance because if they refinance right now, the interest rates are going to be higher, which defeats the purpose of getting the assumable loan to begin with. So it's not something people strategically want to do. These are a couple things that people need to know whenever they are looking at assumable home loans. If it is going to be something where all that history and all that mortgage activity stays with the previous seller, it's benefiting the seller's credit. It's not benefiting the buyer's credit. So while you are assuming that loan and making payments, your actual trade line for the mortgage, your credit scores, your reporting history is not being affected in a positive way at all. It's the previous person. So if you need that for your credit history or you want that for your credit history, just understand it's not going to be effective to be on your actual report unless the servicer fully transfers it over to you and starts it over, or you refinance out of the seller's previous name into your name. So just some key things and some key takeaways that I want you guys to understand about assumables because they're popular. There's a lot of buzzwords out there, but there's a lot of behind the scenes checks and balances that I want to make sure you guys know before you start having those conversations. So listen, hopefully you found this video useful or helpful. If you did, do me a favor, like, comment, subscribe. If you got any questions about assumable loans or your mortgage position or just anything financially in general, drop a comment below. Myself or my team will probably get back to you. And if you want to have a one-on-one conversation with me, do me a favor. Call us, email us, text us. No question is a bad question. We're always here for you. Until next time, stay tuned.